Hello friends, a warm welcome to the next chapter, which is change in profit sharing ratio. So this is the first chapter which is going to be something, it is a combination of all the concepts which we learned from the fundamentals and goodwill, because this is the first reconstitution of the firm. So if you go to page number 4.1, you can see that the reconstitution can be of 5 types. You can see in that page. First one is going to be the change in profit sharing ratio. So you should understand that change in PSR means what? Suppose there is A, B and C. There are 3 partners, A, B and C. Now their profit sharing ratio was 1:2:3. They were having ratio 1, 2 and 3. Now their ratio has become 3, 2 and 1. Okay, so there is a change in the PSR. Now because of this change in PSR, what happens? B is not going to get any benefit, or he is not going to sacrifice, whereas A on the other hand is going to get more, because earlier his ratio was 1/6. Now he is going to get 3/6. Okay, whereas C on the other hand, who was getting 3/6, will be getting 1/6. So he is going to lose. So that is what we call sacrifice. So now one person is going to gain, the other person is going to lose. Now all these assets and liabilities, all the proportions are also going to change. So all the benefits, they get transferred from one partner to another because of this change in PSR. So that is the reason why this chapter is very important. So will you accept, so many days I was getting 1/6, suddenly I am getting just little bit more or little bit less. Obviously there will be a problem, either with you or the other partner will surely have some problem. So this is the reason why we have to start accounting when there is going to be a change in the profit sharing ratio among the existing partners. Then the next chapter will get into admission, retirement, death and dissolution. But as of now, change in PSR is the first change which is going to happen, and we'll see how to account all the changes. So keep this in mind. The purpose of learning change in PSR is that existing partners are only going to be there, but there is going to be a change in the profit sharing ratio. Because there is a change in profit sharing ratio, what happens? One guy will be benefiting, one guy will be losing. So how to compensate? That's what we are going to learn. Clear? So this is the first change. Now, so under the reconstitution, if you see, there is going to be change in PSR, admission, retirement, death, and also when the amalgamation of 2 or more partnership firm. So these 5 are going to be reconstitution of the firms. So now let's get into the adjustments which you have to do. Please remember, these 5 adjustments are going to be universal. Okay, for the next 3 chapters also you are going to use the same adjustments. So keep in mind right now, it is very important that you keep in mind these 5 adjustments. The first adjustments is going to be determining the sacrificing ratio and the gaining ratio. I repeat, you have to determine the sacrificing ratio and the gaining ratio. So you determine that. That is the first step. Second step is going to be accounting of goodwill. So because there is going to be a change in PSR, goodwill will be valued and it will be distributed. Okay, we will see that in detail when we go to that topic. The third one is going to be accounting of reserves, accumulated profits and losses. Now what happens over here? These reserves which are going to be there on the liability side, and the accumulated profits and losses which will also be on the liability side, these have to be distributed. Originally they belong to the old PSR. Now because there is a change in PSR, what happens? One guy will lose, one guy will gain, right? So because of that reason we will distribute this now. Okay, why should the new PSR benefit one guy? Correct? So that is why it is distributed. Then revaluation of assets and restatement of liabilities. If this, whatever change in the value of assets, suppose my building is worth 1 lakh, tomorrow my building worth, I know it is going to be 1.5 lakhs. Now just because there is a change in PSR, I will be losing that extra 50,000. It's also my benefit. Because of the change in PSR, I am going to get less profit, and I'll also get less value on the revaluation of assets, right? So I'm going to lose something. So that is the reason we have to account it right now. Then we have finally adjustment of capital. So because of the change in PSR, so the existing partner, should they hold the same capital? Not required. See, because you change the PSR, now A should hold actually more capital, C should hold less capital. So you either withdraw or you bring more capital. Okay, so this is the last step. So I'll repeat. Number one, you determine the sacrificing ratio or gaining ratio, then you do the accounting of goodwill, then you transfer the reserves, profits and losses, then you do revaluation of assets and liabilities, and then you do your capital adjustment. So these 5 steps should be in your mind for the next 4 chapters. So keep in mind these 5 are very important, because if you keep this in mind, you can work out any comprehensive problem, because this is how it has to be worked out. This is the flow in which you have to work out your problems. So we can first get into the first step, that is your sacrificing ratio and the gaining ratio. The word sacrifice itself means what? Your new ratio is going to be less, your old ratio is going to be more. So we are simply going to subtract from old ratio and new ratio, we arrive at the sacrificing ratio. Suppose your new ratio is more and your old ratio is less, then new minus old is going to be your gaining profit share. So this is how we simply find the gaining and the sacrificing ratio. Now we'll see one illustration over here. Illustration 1 on page number 4.3, a very simple illustration. Amit and Sumit are partners sharing profits in the ratio 2:1, that is 2/3 and 1/3. They have decided to share equally. They want it to be 1/2, 1/2. Calculate the sacrificing gaining ratio. So Amit's ratio was 2/3. Now the new ratio is 1/2. So when you subtract, you get 1/6. So since you are getting a positive figure, obviously it is a sacrifice. When you get a negative figure, it is going to be a gain. So Sumit is going to have minus 1/6, which is gain. Let's go to the next illustration, where Lalit, Mukul and Chetan are partners sharing profits and losses equally. It was decided that Chetan will get 1/5 share in the profit. When Chetan is getting 1/5 share of the profit, that means Lalit and Mukul will be getting 1 minus 1/5, which is 4/5. This 4/5 you can split, since the information is not available, you can split it equally. So 4/5 into 1/2, that is 4/10. 4/5 into 1/2 again 4/10. So then you arrive at the new profit sharing ratio and you find the sacrificing ratio. So this is very easy to do, but when you come to illustration 3, where the technical part is, you can see over there, in case 3 you can see, as per the new agreement, XYZ decided to share the future profits and losses equally. Okay, but their old ratio was how much? 5:3:2. So this looks a little easier. Okay, you have to simply subtract. But if you go to illustration 2, Z takes 1/5 share equally from X and Y. So what happens? Z share is how much? 2/10. And he is going to take equally, that is 2/10 into 1/2. 2/10 into 1/2 from whom? From X and Y. So we will simply subtract 5/10 minus 1/10, and 3/10 minus 1/10. So it will be, the new ratio is going to be 4/10 and 2/10, and Z is going to get totally 4/10. So these two, actually case 2 and 3 were little simple, but case 1 and 4 are very important and critical. Just see over there. As per the new agreement, Z takes 1/5 share from X. So the word is from. So please mark it. From means what? You have to subtract. Okay. So 1/5. So 5/10 minus 1/5 is going to be what? 3/10. If you just multiply 2 and 2 on the numerator and denominator, it will become 2/10. So it's easy to subtract. So 5 minus 2 will be 3/10. So this is from. What if it is off? So we'll go to case 4, where as per the new agreement, Z takes 1/5 share of X and 1/6 share of Y. So when you see case 4, so you are going to take 5/10 into 1/5, 3/10 of 1/6. So when you multiply this, you get X should be giving how much? 1/10, and Y should be giving 1/20. So Z total is going to get this 1/10 plus 1/20, which is 3/20. So finding the new ratio of X will be 5/10 minus, he is giving how much? 1/10, and Y is giving 1/20. So 3/10 minus 1/20, so that is 5/20, and Z is going to get 2/10 plus 3/10, so that 3/20, which is 7/20. So we have done with the first step. We'll get into the second step, that is accounting for goodwill. Now as I told you, see the partners who are going to continue in this chapter, the partners are going to continue, right? So they are going to continue with the new profit sharing ratio. And what happens because of this change in the profit sharing ratio, one partner is gaining, one partner is going to sacrifice. So that is what we found out in the first step. Now it is time to distribute the goodwill which is going to be gained to the sacrificing partner. So the formula is, you can go to page number 4.6. Amount of compensation payable is equal to value of the firm's goodwill into the gained profit share. So simply you take the firm's goodwill if it is given in the question, or you have to apply the go through the question and find out which method, whether it is simple, weighted, super profit or capitalization method. Find out the method of goodwill and find the goodwill also, value of goodwill, which will fetch you marks, and then you multiply with the gained profit share. So then the formula is then the journal entry is going to be gaining partner's capital account to sacrificing partner's capital account. Always the sacrificing partner is going to get increase in the capital, right? So we have to credit, and the gaining partner has to give, so we will debit it from his capital account. So gaining partner's capital account debit to sacrificing partner's capital account. Now suppose the goodwill is already existing in the books of accounts. If it is already existing, then it has to be written off by debiting to the partner's capital account. So goodwill is already a debit balance, so we will credit goodwill and debit the partner's capital account. The next third step is going to be accounting of reserves. So when we talk about reserves, we have 4 items to discuss. Number 1, general reserve. Next, P&L credit balance. Third one, investment fluctuation reserve. Then workman compensation reserve. And then on the asset side, you are going to have P&L debit balance, and you are going to have deferred revenue expenditure. Now these 6 items is what we will consider in the third step. So what happens after you finish your goodwill entry, we will immediately jump to this step. So you have to go through the balance sheet. The question will have the balance sheet, or it will be mentioned the questions, all these figures. You have to find it out and then transfer this to the partners. So for the first one, that is general reserve, is generally a credit balance. So we will debit general reserve and credit the partner's capital account. So that is how we will transfer the general reserve. Simple. In the old profit sharing ratio. Remember, it is old profit sharing ratio. The next one is workman compensation reserve. Workman compensation reserve, so it is kept for any kind of claim which arises from any accident. Let's assume there is a factory and there is a possibility of some accident. So at that point of time, to make if there is going to be a claim for any medical expenses and all those things, so that is the time you can use this reserve and you can pay for the claims. Now there can be various situations. Number 1 is that the claim against the compensation reserve is not there. So during the year you created the reserve, but there is no claim, no one has claimed. So obviously this reserve belongs to whom? Partners. So you debit workman compensation reserve and you credit the partner's capital account. That is the entry you will pass. I repeat, you will debit workman compensation reserve and you will credit the partner's capital account. Why we are debiting workman compensation reserve? Because it is a liability item, it is already a credit balance. To nullify that, we will debit the workman compensation reserve. We can keep in mind for passing the entry. Same way, when the claim is going to exist and the claim is equal, we will have 3 situations there. If the claim is going to be equal, that is your workman compensation claim is going to be equal to your reserves, then there is nothing left to be distributed to the partners. So we will simply pass the entry workman compensation reserve to workman compensation claim account. Okay, so we will just transfer the reserves to the claims account. Suppose the claim is less. Okay, the reserve is 1 lakh and the claim is only 80,000. Still you have 20,000 reserve is left, that we can give it to the partners in the old profit sharing ratio. So we will have workman compensation reserve account debit to workman compensation claim to partner's capital account. Suppose the workman compensation claim is more. You had only 1 lakh, but the claim was 1 lakh 20. So what happens? You have to give 20,000 extra as claim. So when the claim is going to be more than your reserve, then you debit workman compensation reserve, you debit revaluation, and we will credit the workman compensation claim account. So it's simple as that. and now this revaluation has to be transferred to the partner's capital. So we will pass the entry partner's capital account to revaluation. The next reserve is investment fluctuation reserve. Investment fluctuation reserve is again going to be kept as a reserve like the way we saw for workman compensation. This is going to be kept for any fluctuation in your investment value. So we will compare the investment value, which is the book value, with the market value. Suppose there is a change, there is a fall in the value, we will use this reserve. If there is an increase in the value, obviously we are not going to touch this reserve, but we have to see whether the market value is more or equal or less. Okay, so let's take the first situation. When the market value of the investment is equal to the book value, that is, you invested 1 lakh and the market value is also 1 lakh, then this reserve is not required. You will transfer this to the partner's capital account. So investment fluctuation reserve account debit to partner's capital account. The second situation is when the market value is less than the book value. So if your book value is say 1 lakh and your market value is say 80,000, can you keep the investment at the same value? You can't. Okay, you have to bring it down to 80,000. So we will credit investment, right, and debit will go to investment fluctuation reserve. So investment fluctuation reserve to investment, and the balance, if any is there, that will go to partner's capital account. Okay, then suppose the fall in the value is equal to the investment fluctuation reserve itself. That means you have no excess left, so simply pass investment fluctuation reserve to investment account. Okay, so your investment value will also come down, your reserve will also go off. Suppose the fall in the investment is more than the reserve itself. Now the fall in the value is more than the reserve. So again we have to touch revaluation. So we will take use of revaluation. So we will have investment fluctuation reserve account debit, revaluation to investment account. Because we are touching revaluation, we have to transfer this to the capital account. So partner's capital account to revaluation account, this is the entry will pass. Suppose the market value is high, it is more than your investment as such, then the reserve is not required. You transfer the reserve to the partner's capital account. And also whatever is the increase in the value of the investment, the market value, debit the investment to that extent and credit will go to the revaluation. Again this revaluation will go to partner's capital account. Next concept is deferred revenue expenditure, 4.15 page number. You can see that this deferred revenue expenditure will be on which side? Asset side. So we have to credit deferred revenue expenditure and debit will go to partner's capital account. So it will become nullified. It might happen that the partners decide to adjust the reserves, accumulated profits and losses, but they want to retain them in the books. Okay, and the existing balance are to be retained. So what we do is we go and do something called net effects. Okay, so we already know there is going to be a change in the reserve. Okay, increase or decrease is there. Okay, so all those net effect we will see. So you can go to page number 4.18 where they have mentioned the step 1, that is you calculate the net effect of reserves, accumulated profits. Step 2, you calculate the gaining ratio and then you split it and you pass the gaining to sacrificing partner's capital account. So this is very simple. Directly you pass this entry, which is the net effect when they are planning to retain. In the previous entry what we learned, we are actually going to nullify, right? But now they are telling no nullification, we are going to retain them. So only the changes are going to be affected, means we will take the net effect alone and we will debit the gaining partner and credit the sacrificing partner. The next step is revaluation of assets and liabilities, where there is going to be an increase in the value of assets. We will have to increase the value of asset, right? So asset will be debited and credit will go to revaluation. If there is a fall in the value of assets, we are going to debit revaluation and credit asset. And if there is going to be increase in the amount of liability, then we are going to credit liability and debit revaluation. And there is going to decrease in the amount of liability, means we will debit liability and credit revaluation. And if there is going to be any unrecorded assets and liabilities, we will record them. So unrecorded the assets to revaluation, and when there is going to be unrecorded liability, revaluation to unrecorded liability. So whatever difference you get, that you have to transfer to the partner's capital account. So by this I think we would have come to a conclusion that first we transferred the goodwill entries, then we transferred the reserve entries, now we are transferring the revaluation entries. So these are the entries which will go to the partner's capital account. So keep this in mind. So that the purpose is that only. Then suppose there is going to be some expenses on reconstitution. So you can go to page number 4.21, where you can see there is going to be some expenses on reconstitution. You have to just pass the entry revaluation. If it is paid to a partner, then it is revaluation to concerned partner's capital account. If it is paid by the firm itself, then it is revaluation to cash or bank. So again, whenever there is going to be change in the value of asset, the asset value will increase or it will decrease, or the liability is going to increase or decrease. Now the partners decide that they should not change the value of assets. So again we will go with the net effect method, like we decided in the previous concept also. You can go to page number 4.24 and mark it important. When the revised value of assets and liabilities are not to be recorded, so you first calculate the net effect of the realization. So you add the increase in the value of assets, to that you add the decrease in the amount of liability, then you subtract the decrease in the value of assets and increase in the value of liability. So you get something called the net effect of revaluation. Find the sacrificing ratio, split it between the sacrifice and gaining partners, and pass the entry gaining partner to sacrificing partner, same entry once again. We are going to pass goodwill entry, we are going to pass reserve entry, and then we are going to pass revaluation entry also. That's it. With this, your new balance sheet is going to be ready, and then comes the adjustment of capital. So because of this change in the capital, what happens? Because of the change in the PSR, obviously the partners have to either bring in more capital or they have to withdraw some capital, because the ratio has changed, right? Obviously the capital contribution should also be in that proportion only. So if that is going to be there, then some partner might need to get more capital. So you can go to page number 4.29. You can see that if more capital has to be brought in, then bank account debit to concerned partner's capital account. Suppose bank is not enough, okay, he doesn't have money, then we will use his current account. And suppose it is a surplus of capital, then we have to withdraw, right? So partner's capital account to bank or concerned partner's current account.